Very glad to be here. I'll try to make it quick because we're running a little bit over. Nick earlier talked a lot about fundraising, and he made some of the points that I'm going to make. But actually at Atohum, like 3 years ago, Barack asked me to give a talk, and I love analytics. I'm a nerd. I'm a computer science guy, developer, product, and I love data and I love analytics. So I thought I put all this time into making this presentation about analytics, how you analyze funnels and A/B testing and retention, and I thought I was like really helping these guys. And then it came to the QA, and we talked about fundraising for like 30 minutes. So here you go, how to raise a seed round. Do I have a clicker? Okay, just quickly, my background. I went and studied computer science at MIT. Right around that time, I had two close friends. There was Kyle Vogt, who dropped out of school and went and started Justin TV. That became Twitch TV. Arash was from my hometown. He dropped out and went out and started Dropbox. So it was kind of like the beginning of this really exciting time where like the smartest of the top schools were no longer going to consulting companies and finance. They were starting to go to Silicon Valley. And so I thought, hey, that looks pretty cool. I think I'll try that. And so I applied to Y Combinator with, it was actually an education company. We were selling to schools. It was a foreign language learning space. We had no idea what we were doing, but we worked hard. We never made a cent, but we got some users, and we got acquired by dictionary.com. And right after that, without even taking a break, I went and worked for dictionary.com for a little bit, and immediately started another company. Applied to Y Combinator, got in again as a solo founder working in art. I started an art company, and that went okay actually. It was the first one. We never charged anybody any money, which you can't really get away with as much these days. But I was actually making money with this one, and it felt awesome. People were giving me money. But after working on it for a year, I realized. It couldn't scale. Like, just because you have a small business that makes money doesn't mean it's going to turn into a big business that makes money. And so I learned, in the school of hard knocks, what a scaling problem is. And unfortunately, around that time, and I mention this because I think it's prevalent, ubiquitous in the startup community, and we don't talk about it a whole lot. But I was burnt out. I started this first company, worked on it for 2 years, got it acquired, went and worked, immediately started another company by myself, worked on that. Couldn't get it to work. I was completely burnt out. And I think that occurs a lot. Going through YC, I've now seen hundreds of companies, some that have gone to be very successful, most of which fail. And this happens to more people than you probably know. People get depressed, people get burnt out, and that's where I was. I don't really know if I could have made that art company work. Maybe I could have. Nobody's made it work yet, even though similar companies have come out, but I didn't. I was burnt out. And so I realized I was spending all of my 20s working my ass off in Silicon Valley. And so just a personal goal of mine was to always move outside of the US and live abroad. And so now I work my ass off in front of a computer in Istanbul. So I've been here for 3 years now. And so another thing I wanted to mention, so there were a few things that I don't think get usually hit on in conferences like this. One is sort of like burnout, depression. And another one is, like, we're all here. Aurora mentioned dominating the world. And from hearing most of your pitches, you're working in big markets that could go on to dominate the world. But I was in a position when I moved to Istanbul, I was like, the art one was supposed to be big. The original education one was supposed to be big. You know what? I've gone to things like this. I've read all I can about starting companies. I'm just going to apply what I've learned and build a small niche business. I'm going to build what's often called pejoratively a quote-unquote lifestyle business. But they're pretty sweet, to be honest. So I built this. I read like every Turkish grammar book ever written in the course of about 2 weeks, and I started writing about 200 Turkish lessons. And then I went to Boğaziçi, found a master's student in Turkish linguistics, and we started making podcasts together, and we started charging people $10 a month for that. And now that's the largest Turkish learning website on the planet. And no, the Turkish learning market is not very big, but it makes a decent monthly revenue. I don't work on it at all anymore, except to answer some customer support emails. And so that's the kind of business, if your world domination plans don't work, you can be a successful entrepreneur having like a very decent business that doesn't make $500 million a year. After that, so that was language learning. I love language learning, if that wasn't clear. I'm passionate about it. I enjoy building products for it. I built a spaced repetition app. I used Anki a lot, Memrise. Some of you may have used this to learn things. It uses algorithms to track your learning. And I thought I could do a better job, so I built a series of iOS apps, launched that. Those generate revenue each month. So now that I have a couple businesses under my belt with monthly revenue, I'm now in a very comfortable position to start a company that has a little bit higher ambitions. And luckily, I'm in a position where I don't really need to worry about money too much because these two are funding that one. And so, like, I'm you, literally. I launched this thing 2 weeks ago. So some of you are further along with your companies than I am with that one right now. And also, I raised money for that one. Spoke to a few people in this room, actually. I raised money here in Istanbul. For that one, I raised a seed round. So I've raised seed rounds in both Silicon Valley and Istanbul. So, finally, how to raise a seed round. First of all, raising money is not a success. There's sort of this story about entrepreneurship that you raise money, you get in office, you hire, you're in the big leagues now. I think that conception is a big disservice to what we do. It's either a blessing or a curse. Money's not going to save you if you don't know what you're doing. And so right now I'm going to do the unconventional thing of trying to convince you not to raise money. First of all, so here's why you shouldn't raise money. First of all, like there's this prestige to getting Sequoia Capital or a prestigious angel investor or Y Combinator. But that's your baby, man. Like, you stay up all night working on that thing. Like, you're giving away part of it. Equity is not nothing. Like, owning 90, 95, or 100% of your company is pretty sweet. And so don't take it lightly. Like, giving away equity in your company, it means something, and you should think about it. And then I just talked about this one, the prestige. A lot of people raise a lot of money, and you feel like it's more real, like you're a real entrepreneur when you can afford an office and afford to hire and afford a cool sign outside of your door. I think this is the case with a lot of companies here. You're starting to grow. You feel like it's time to raise money because that's sort of the mantra amongst all of us. But you don't really know what to do with it. It's like the same slide on every one. Like, we'll spend it on advertising. We'll use it to grow the team. We'll use it to test ad channels. And those can be legitimate answers. But lots of times I think, and I've done it too, like, we're just like, we want some money in the bank. But once I have it, I don't know. Not exactly sure what I'm going to do with that. And then the other one is you can wait. Like, especially a lot of you that already have growth, you may be able to secure a much better deal if you continue growing over the next 6 months. Especially in environments that aren't California. Like, the term you got to give away a lot of your company to raise a decent amount of money. And so if you can stick it out for another 6 months or another year and have the traction to really raise on the terms that you want, that's fantastic. Okay, so if I haven't convinced you, then this is why you should raise money. I think fundamentally it always comes down, you're trading equity in your company for time. You're accelerating your success. If you're in a position to raise money, you should feel like you know how you're going to be successful. If given 10 years, you can see the path in front of you to success. And then you go raise $2 million in order to shorten that 10 years to like 3 years. There are some exceptions. If you're building hardware, that's capital intensive. There are some companies that have to scale to work. You need money to do that. So, but for the most part, you trade money for time. And what do you do with that money? How do you shorten the time it takes you to succeed? You hire people that can help you. Maybe you don't have a good designer on the team, but that's huge to your success. You hire them. You get investors or add to your team that provides some sort of market connection. If you want to sell in the Middle East, have no connections in the Middle East, then you're probably going to need some sort of connection there. And then certainly, if you find an ad channel where you put in $3 and you can get $10 out, go raise money and dump all the money in that you possibly can because you've created a money printing machine. Okay, so I want to talk like tactical now. So we've all decided to raise money now, right? We're all in that frame of mind. The worst thing you can do is approach it casually. Like, fundraising is a specific sort of goal that you should approach like anything else, right? Like if you're approaching funnel analytics, you use certain tools, certain strategies, you do it very methodically. You should approach fundraising in the same way. And there are two ways to raise money. You can either raise money on hype, which means that you've got a fantastic team, a really exciting market, maybe you have a couple acquisitions under your belt, or you raise on traction, which means you have the numbers to show. This used to happen a lot more, and you can still get away with it if you do have a phenomenal team, which some of you certainly do. But for the most part, a lot of these services are so cheap to make these days, there's really no reason why an investor wouldn't ask to see some sort of traction. Nick mentioned this earlier, but this should be your team at home working, and this should be you or your partner, just one of you, that dedicates all of their time to fundraising. It's a full-time job, it's distracting as hell. Nothing is harder than going and having 3 investor meetings and then going home and trying to build your product. It's incredibly distracting. And so just one person needs to do it. And raising money is just like dating. Investors, it's exactly the same. You know, investors look at companies. Okay, so if I like a girl, right, or a guy, then you know, they seem okay. They seem interesting. Few interesting hobbies, pretty attractive. But I don't know. And then I see that guy or girl go and start like, you know, flirting and hugging and dancing with the person across the room. All of a sudden, I gotta have that. And it's the exact same with investors, because investors want what they're herd animals. And actually, it's funny because Nick put a very, very similar image in his presentation. They want what other investors want, right? They talk to each other. And that's actually on a side note, that's the main advantage of 500 startups and Y Combinator and other incubators. They break that asymmetry. They allow entrepreneurs to talk to each other in the same way that investors talk to each other, and I think it's extremely valuable, something I hope that develops more here. But investors want what other investors want. They want startups that don't need them, startups that are going to continue working without their money, and that they might miss. Like the worst fear of an investor, like Nick said, is that you're the next Twitter, and they miss it. Like if they want to make money, they can go invest their money in bonds or emerging market funds. They're investing their money in startups because they want to make a lot of money. So you need to create a competitive dynamic. This is that dating thing we're talking about. So you need to book. Okay, you've made the decision that you're going to fundraise. All right, we're not taking this casually. This is something we're going to do. So you get as many meetings as you possibly can, and you jam them as close together as you possibly can. You get the intros. You know, hopefully you've been working on your network. If you need to do cold emails, if you need to wait outside the exit door and ambush them, do whatever you have to do to get the meetings, but schedule them back to back to back, because you want to be able to leverage your conversations with investors over the others, right? And another reason you have your team back at home working is because you want to time it so that you have some sort of news or multiple pieces of news when you're out fundraising. All right, so I have a meeting, I talk to an investor, I don't get the yes, but next week we launch and we have 3 big articles, or we you know, hit 10,000 users, or whatever. Try to time it so that you have some exciting news, so you have justification to check back in with investors and excite them. So what do like investor meetings actually look like? Also, if you're looking for a Series A, this differs a little bit. But right now we're talking about like angel investors because I think that's what most people are approaching. Make a presentation, make an airtight pitch deck, but then try not to use it. All right. Usually they're done over a beer or a coffee or a tea. You go in, you sit down, like make your pitch casual, talk to them, like get to a conversation as fast as possible. Like you want it to turn into a two-way street. You want to get their gears turning. You want them to think, well, if they did this, then potentially it could grow like this. And I guess the opportunity, but they're kind of like you want the investor to think. You don't want to just talk to their face for 10 minutes. And so make your pitch short, make it quick, make them believe that you could potentially make $100 million one day, and then just talk about it. Because even if you don't get their money, you're going to get advice. And my advice would be straightforward. The advice that of ask for advice. What is it? Ask for advice. Right. And I think that's absolutely true. But once you make the decision to fundraise, I would recommend being straightforward. Send an email, say, hey, we're raising a round. I'd love to meet and discuss this. If you already have a previous relationship with them, all the better. But I don't think it's a good strategy, and I think it can be frustrating for investors if you make meetings where you kind of like sneak in the back that, oh, we're kind of raising money. No, just be upfront about it. Hey, we're raising money, and we want you to be involved. Go in with your terms ready. I think it's effective to go in and be like, this is what our cap is, this is what our valuation is. I was going to talk about convertible debt, but I don't know how that differs from country to country. Or is it possible to raise convertible debt for most people in here? Not really? Okay. Well, whatever it is, you're either going to be mostly negotiating either your convertible note cap or your valuation. So go in with what you have in mind, and then be willing to budge on it if that's what you're willing to do. I will say that the first investor, for the reasons we talked about early, is extremely important. Once you have that first investor, it's much, much easier to get the others. And often a first investor can bring their friends in to make the second or third. And once you can go to an investor and say, hey, we talked earlier this week, I want you to know we got our first yes, we've got this amount committed, conversations then go much, much easier. So if you need to make the terms a little bit more friendly to get that first investor, it's your decision ultimately, but I think that can be a worthwhile choice. And finally, always be closing. It's like Nick said, investors will waste your time because it is to their advantage. They don't want to make a decision because why would I invest in you today if I can know where you're going to be in 2 weeks or 3 weeks? Like, I can see your numbers from 3 weeks from now and make a decision based on that. It's always to an investor's advantage to wait as long as possible before making a decision. And so when you go into a meeting, don't leave with it open. Like a lot of times investors will try to close with, well, hey, this has been really interesting, handshake, we should keep in touch, I'm really interested in what you're doing. Don't do that. Just, be forceful, be polite always, but say, hey, we're really looking to get back to work, this fundraising, we really want to put this to bed, and we really want you on board. So, I want to give you time to think about it, but when can I plan on hearing from you again? Or even say, we want to close this, by the end of next week. Do you think I can get a yes or no from you by then? Just be upfront about it. And then, just like I said, yeah, beware. Like Nick said, maybe if somebody gives you a lot of maybes, just move on. If some people were kind of on the fence and you decided to move on, you can get back in touch with them after you've raised 75%. You can say, hey, we're 75% committed. If you jump in, then we'll be done and we can move on with our lives. And that could potentially work. And finally, don't count the money until it's in your account. I think the etiquette is sort of like, we talked about soft circling. If you get a handshake deal, you can say committed, 10K has been committed. Don't ever be disingenuous about the actual amount of money that you've raised, because for a million different reasons, something can happen between a handshake and before the money actually hits your bank account. And so congratulations, you've raised money. Now nothing's really different. You're still faced with the reality of building a startup, so just get back to work. Thank you very much.
Nice. That was really nice. So, as he said, like Steve Blank, who you will hear, compares celebrating the round of success and celebrating, it's not appropriate. Nah, I'm not going to do it. I'll do it in private. May not be appropriate for the clients. So don't celebrate fundraising. The real job starts after fundraising. One quick question. If you're halfway through, you try to raise $200,000, you raised $50,000, and you're not just able to get the other 150.
Yeah.
What would you suggest in that sense?
Well, that's why you usually want, if at all possible, you want to raise in a position in which you don't really need the money. And so hopefully you can just take the 50K, adjust your plans a little bit, and then move on. But in the case, it depends on the startup. If you can't operate with more money, then you should return your investors' money. There was one point, actually, that when the art company wasn't working out, I returned $50,000 to an investor because that's what he invested in. It didn't work in. He didn't want anything to do with teaching Turkish. And so, your reputation will follow you everywhere. Your startups will come and go. But if you ever get a reputation for being dishonest or breaking a deal, breaking a handshake deal, then that will follow you forever, and nobody will ever forget. So.
becomes kind of a curse. Some startups are in that stage. We raised 50. I'm still looking for money, but I'll start working on the 50. Well, then, at the first step, you probably didn't need 200 then. Why do you think you can work the same things with $50,000 when you started telling people you need $200,000? It means you really don't know how much money you need to do what. Well, we're raising $200,000, but yeah, 20 is good enough. And then 20 is not good enough. It means it's better not to do the business with the 20 if that's your ambition. You just can't do that to investors. They will follow you back. Anything else? Who's in that situation? Who's in the middle of a fundraising round? I know who you are. Come on, raise it. All right. 1, 2, 3. What's your biggest problem? All right. Although you have the first one, you're having trouble in getting the second and third. All right. You have any guess or hypothesis, and why is that? All right. How long it's taking you now? All right. When do you plan to close that? If I can't get the money from the second and the third, do you have a cutoff date for yourself? All right.
Yeah, I think the biggest danger is just getting in a position where you are trying to straddle raising money and working on the product. It's a miserable experience, and everyone sort of suffers because of it. So that's the one thing that I would just try to prevent. Just if you're going to fundraise. When you're done, and do what you can with the money that you have.
Focus, focus, focus. Thank you so much. Enjoyed a lot. Good job.